Research Asia Pacific, joining us from Hong Kong. Manishi, thank you very much for joining us today. Boy, oh boy, it's been a pretty fraught year so far, hasn't it, for the global markets? Are we just right now in the eye of the storm, the short period of relative calm in the middle of a tropical cyclone before things get a little rough again, especially now that the Fed this month is going to be starting QT on top of its rate hikes?
You hit the nail on the head absolutely there. I think, we are in a relatively calm period. There has been a risk-on environment that's been triggered by some degree of opening up in China, more fiscal and monetary stimulus emerging from that economy. There has also been a commentary, a narrative, that the risk perception is way too high among institutional investors, and that has led to this, approximately 10% upside from the lows in mid-May. That said, we must also keep in mind that we are now about to enter a period of quite severe monetary policy tightening. We think that the Fed would hike 3 more times by about 50 basis points. They're entering the QT phase, and this episode of QT is likely to be much more severe than we have seen in the past, in the 2017 to 2019 episode. So we have to brace for the impact, at least in the next 1 quarter or so.
Indeed. So the bathtub is being drained of liquidity, which is never good for the markets. But from an investment point of view, Manishi, if you're a long-term investor, it's probably too late to sell, right? If anything, you could be nibbling, and you certainly just don't want to just sit there and do absolutely nothing and hope for the best. So what would you be doing actively?
For the near term, capital preservation should be the key for most investors. And there are 3 or 4 strategies, 3 or 4 themes that we are recommending to achieve that. First, yields are going up and are likely to go up in much of the world, and therefore the banks, the financials, particularly in the so-called developed Asia financials, they're likely to continue to outperform. Second, energy and materials prices, particularly energy prices, will remain buoyant for the foreseeable time horizon. So that's another universe to play. Third, we think one should focus on high and sustainable dividend yields at this point of time. There are enough pockets in Asia. We have the Chinese SOE banks, we have many of the Indonesian companies or Southeast Asian companies, particularly in the area of energy and materials. We have a few of such pockets in other parts of Asia as well, in Korea and India. Finally, I would also point out that selectively, the tech hardware exporters and the IT service exporters of this region, they tend to gain from continued demand buoyancy in the Western Hemisphere, in the developed markets. And many of these companies also benefit from moderation in the Asian currencies, because much of their revenue is denominated in US dollars. So these are some of the themes that we are focusing on. Apart from some tactical exposures in the reopening plays, particularly in Southeast Asia and in Hong Kong.
Now, Manishi, if I could just follow up on the reopening plays there, as that is the big story today in China. We look to Shanghai, which has been under lockdown for the last 2 months since April the 1st. How would you be repositioning your portfolio given that things are opening up?
Right. So these reopening plays that I mentioned just now, I would rather play them through the listed exposures available in Hong Kong, through the retail REITs, through some of the consumer discretionary companies which are operating in this region and catering to the travel and tourism space. There are a few others which are also service providers to that space. So, not all of them are very large, very liquid companies, but at the same time, there are quite a few of these small pockets which can, form a significant portion of an investor's portfolio.
We've seen the Chinese markets underperform year to date. Shanghai is down about 12%. valuations are cheap, would this be a good time to get in the market?
I would say selectively, yes. We are currently neutral on China. We think that there are some pockets within China which do make sense for institutional investors. I gave the example of financials. I mean, even the usual theme of net interest margin expansion because of yields going up, that does not yet apply to China. But the SOE banks, they do provide a cushion as a consequence of their high dividend yields and low exposure to the risky sectors like property. I would also give the examples of tech hardware companies in China, which are clearly a beneficiary of policy focus. And finally, a select few consumer discretionary names, the ones which are market leaders and therefore able to pass on the input cost, and the ones which are beneficiaries of this round of reopening that we expect to continue for some more time.
Lots of investment ideas. Thank you very much, Manishi, for sharing those with us. ManishiRaychaudhuri from BNP Paribas.